Again, good evening, everybody. This is Ebere, Okoye. Welcome to the Year-End Tax Planning and Taxmageddon webinar. If you have any questions, please feel free to send across your questions right now. And then we will start with the webinar in a couple of minutes. I hope everybody enjoyed their Thanksgiving. I definitely enjoyed mine. All right, so we will go ahead and get started. This evening, we're going to be covering a lot of information, so I strongly suggest that you grab pen and paper so you're able to take a lot of notes. Tonight, we're going to be talking about year-end tax planning as well as the Taxmageddon that we have coming in 2013. All right, a little bit about myself. Again, my name is Ebere Okoye. I'm a CPA and a real estate investor and the founder of the Wealth Building CPA. I own several real estate properties across the Eastern Coast. My primary strategy is buy and hold, and I also do occasional rehabbing. And I find joy from working with clients and investors and small business owners such as yourself to help you plan your wealth building program and to make sure that you're making the most of every opportunity that you have. You're not paying more taxes than you need to, and that you're setting up yourself to fulfill your dreams. What is the wealth building CPA advantage? Being in the industry for so many years, I'm very familiar with money-saving strategies that I love to implement. I've been a CPA for 18 years and a real estate investor for 11 years. So with this combination, I am able to empower you to make your financial life so much more profitable. One of the things that I often hear from small business owners and from real estate investors that it's hard to find CPAs who really get their business, understand their business, and know how to implement strategies that work for them. So that's what the Wealth Building CPA brings to the table. Usually we suggest that everybody acquaint themselves with the ultimate wealth building plan. This is a plan that each of our clients go through every year. If you want to build wealth, you want to make sure that you're going through all these stages. So we're going to go through these stages pretty quickly to explain what these stages are, and we are going to be focusing on the last stage this evening. So the first stage of the Wealth Building Program is the Financial Needs Analysis Questionnaire. We want you to fill out the Financial Needs Analysis Questionnaire so we can, get a picture of where things are. Where are you today in your financial life? What kind of skill set do you have? How much money do you have? Where do you work? What's your real estate strategy? With that, we're able to come up with a plan that sets the stage for the rest of everything you need to do. In stage 2, we look at tax planning and preparation. We review your prior year tax returns. We look at future taxes that are going to be coming down the pike for you and your family. And we do some kind of planning, look at any missed deductions, any audit flags, any other loopholes that we can take advantage of to save you on taxes. Then after that, we look at your entity structure. We take a look at your real estate strategy or your business strategy and come up with the best entity structure that will do 3 things. 1, save you on taxes. 2, give you asset protection. And 3, very easy to comply with in terms of the state requirements. Once we choose your entity structure, we move on to stage 4. We can actually help you set up your business. Get the business registered, get your EIN numbers, draft your operating agreement, help you with bookkeeping, open up the bank account, and then make sure that this is something you're doing every year to keep your business in good standing. And then we also do business analysis meetings in stage 5. Most of the time, each investor is, your one-man shop. You're wearing all the hats. So the goal of a business meeting is to have an objective third party taking a look at your business and seeing ways that you can improve the bottom line for your business or reduce your expenses or go into another line of business. For example, you could start out as a wholesaler, and we would advise you to maybe moving on to rehabbing or buy and hold or commercial investing. And then stage 6, because I'm an investor myself, I can assist you with investment property purchasing. analyzing the deals, making sure that it's a good deal, making sure that you make money when you buy, not when you sell. So all of that comes under the investment property purchase. And then we also do a retirement plan and taking a look at, how much money you save for retirement. Would you be better off setting up a self-directed IRA or a solo 401k account so that you're invested in real estate through your retirement account. And then the last stage, which is what we're getting into this evening, is year-end tax planning. Year-end tax planning is something that we do every year for our clients because we know that April 15th is your tax filing deadline. It's not necessarily your tax savings deadline. And so one of the things we do is that November, December, we're getting information from our clients to see, how much money they've made for the year, what kind of changes happened, how many properties they bought and sold, so that we can get an idea of what their tax liability is going to look like. And then we now strategize on ways to save on that taxes before the year runs out. Now, like I said, getting a head start in September, November, December makes you a lot happier in April because it gives you a bigger refund or you have to write a smaller check to Uncle Sam. And, you have a choice. You either pay the IRS, you pay a tax preparer, or you pay a qualified CPA such as myself to come up with some tax reduction strategies. Remember, once December 31st has come and gone, your tax liability for the 2012 tax year has been set in stone. Until then, and especially now that your final tax picture is becoming clearer, year-end tax planning presents a unique opportunity for you to lower your tax bill. So there's so many things that we could do between now and year-end. Setting up a new entity, having you prepay some deductions, strategizing on some income that you could defer into the next year. Now is the time for us to do that. I'm just going to go through real quick before we get into the meat of our discussion this evening when we talk about a year-end tax planning checklist. If this applies to you, then you definitely want to consider year-end tax planning. If you own a business, do you have an EIN number? Do you have an operating agreement? Do you have a separate bank account for your business? Remember that the audits are on the rise for small businesses, especially real estate investors and with everything that's happening in the economy. So you want to make sure that you are really operating your business as a business. You're not operating it as a hobby. You're not commingling funds. And so these are one of the things that if you know that you don't have an EIN number, you don't even have a registered entity, and you're just operating as a sole proprietor, you may want to consider year-end tax plan. You still have time to get your business registered and set up before the year runs out. The next thing that we want to look at is all the income and expenses that you have for the business. Is it in the business bank account, or is it currently sitting in your personal account? Meaning, are you commingling your funds? This is definitely a huge audit item. You want to take a look at that. If you have some expenses, maybe let's say on your credit card, or you have some expenses that you paid out of your personal account, you want to use what we call a cash sweep to get those expenses onto the books of the business so that if you get audited, you're able to show that these are business income and expenses. If you own investment property or even your primary residence that was foreclosed, through a short sale or just a general foreclosure, have you considered the impact of cancellation of that income on your individual income taxes? I cannot tell you how many people have taken a hit on this because they were told, oh, you don't get to pay taxes on cancellation of that income. But if you own a rental property and you've been taking depreciation on that rental property for, a period of 5 to 6 years, you've accumulated depreciation over the years. And let's say you refinance that property and you got a loan on that property, and then now it's being foreclosed or you're doing a short sale. More than likely, you may have some tax liability because even though your cancellation of that income may be eliminated, let's say if you can establish insolvency, you may still have income because you now need to reduce your basis by the depreciation that you took over the years. So this is something that you definitely need to consider. If you have family members or other investors, other business owners who have this, you definitely want to encourage them to consider year-end tax planning. If you generated any kind of active real estate income We want to know if you've considered restructuring your business to look at the impact of self-employment tax. This is very important, especially if you're a wholesaler or you're a rehabber. Whatever income you generate is going to be subject to self-employment tax. So you want to look at maybe restructuring your entity, maybe into a multi-member LLC or an S Corp. There is still time before the year runs out to get that done to help you, to help save on your self-employment tax. Again, if you have any questions, I will answer some questions at the end. Feel free to start typing your questions in the question box, and I'll get to those questions at the end. So this is what I just covered. The first part of this webinar is the year-end tax planning. If you think you are going to need year-end tax planning, you want to talk to us, please feel free to give us a call at 1-888-502-3767, 1-888-502-3767, or you can go to our website at thewealthbuildingcpa.com and request a consultation. We ask you to send in copies of your pay stub, a list of your business expenses, your prior year tax returns, all your entity formation documents. We review that and we come up with strategies. And for most of our clients that have taken advantage of this, they definitely see the impact come April 15, October. If they're able to make more contributions to a retirement plan, they're able to prepay on a mortgage. In December, we set up an entity so that their self-employment tax goes down. There's definitely a huge impact for people to think about, taking advantage of year-end tax planning. Most people are just used to filing their taxes once a year. But here at the Wealth Building CPA, we try to take a look at your tax picture at least twice a year, at the end of the year and then when it's time to file. Now, another important thing that we want to go to that is very, very, very important is what we call Taxmageddon, the tax increase that is going to affect everybody, especially if you're in the Washington, D.C. area, in California, or New York. This is going to be a huge impact. The reason why we're covering it now is because it's very important not just to look at the 2012 tax season. It's equally important that you look at the 2013 tax season, because by looking at the 2013 tax season, you're able to plan for the 2012 based on what you think is going to be coming up in 2013. And that's why we're covering it early now. Some of these things may not happen now. We're still waiting to hear from Congress on what their decision is going to be. But pretty much we know that some kind of increase in taxes is going to be coming. So I want to cover those quickly, and then we can go to our questions. So everybody has been talking about we only have 4 more weeks for the dreaded fiscal cliff to come. We're hoping that they'll be able to come to a compromise, the Democrats and the Republican Congress, that they come to some kind of agreement. But either way, no matter what the agreement that they come to, 80% of Americans will see a tax increase in 2013. So that means a typical household should see about a $3,700 increase in your bottom line taxes. Some way, somehow, you are going to be affected by this. Now, this tax increases is going to affect everyone, because one thing that could happen is, if you guys remember way back when with the Bush tax cuts, the tax rates were decreased. So the lowest tax rate was 15%. And then with the Bush tax cuts, it went down to 10%. So if the Bush tax cuts expire, we are going to go back to all the tax brackets going back up. So we should expect that may or may not happen, but more than likely some way something is going to happen where there's going to be a huge tax increase. There's going to be the marriage penalty, where because you're married, you're going to see that you pay more in taxes because you're married than if you had filed single. For those that have children that are under 17 years old, you're getting a child tax credit of about $1,000. We should expect that that's going to be cut in half, so it's only $500 per child The capital gains tax is going to increase. Right now, the long-term capital gains tax rate is 15%. We're expecting that it may go up as high as 23.9%. And then we also know that the contributions that you make to your plans, whether it's going to be the 529, the FSAs are now limited to $2,500. Another aspect, because we're dealing with a sandwich here, and that's why it's very important that, especially if you're in the Washington, D.C. area, you understand what we're up against. Not only do we have tax cuts expiring, but we also have what we call sequestration coming, meaning that there's going to be budget cuts. So on one hand, you're dealing with your spendable income going down because you have more taxes, but your spendable income is also going to go down further because of some budget cuts that is going to hit the Washington, D.C. area. As most of you know, most of the other areas in the United States took a hit, back in 2008 with everything that happened with the mortgage meltdown. The D.C. area was kind of protected a little bit because of all the provisions that were put in place, and we're near the capital. But right now it's time for the Washington, D.C. metro area, some parts of California, to start seeing the same kind of hit. So I want to just run through quickly what we expect to see. $215 billion hit to the nation's GDP. The recession is going to be like a fiscal cliff, meaning that you're falling off a cliff, like I'm falling and I can't get up. Cuts are going to lead to fewer jobs, services, reduced spending, especially those in the, defense, in the IT industry. You can expect a lot of budgetary cuts. Huge job losses. D.C. is going to lose over 120 jobs, and not even counting Maryland and Virginia. So what this means is that on one hand, you're paying more taxes. On the other hand, we don't have as much money to spend in the economy. So it's kind of like we're getting a sandwich effect in the Washington, D.C. area. So what this spells is disaster. Now, this is not to scare anybody. This is not designed to make everybody say, the sky is falling, the sky is falling. Advanced preparation is what we can do. There's been a lot of recessions in the past. There have been people that profited from the recession, and there have been people that lost money from the recession. So our goal is by being a member or a part of the Wealth Building CPA family that you can profit from whatever is coming. The first wave of expirations that we're going to see, like I said before, is the personal income tax rates are going to go up. That's the first wave of what we're going to see. The itemized deductions and personal exemptions will phase out. There's going to be a middle class debt tax. Before, this was for the higher income earners. Is going to be the threshold is going to be lower, and there's going to be higher tax rates for savers and investors as well. And then next thing that we're going to see is the Obamacare tax hikes. There's going to be 20 new or higher taxes in the Affordable Care Act. The Medicare payroll, right now, if you make $106,000 or more, you only pay Social Security and Medicare tax on the first $106,000. We expect that to go up, where if you make over a certain amount, over 106, you're still going to keep on paying that Medicare tax or surtax on anything over and above, $200,000. So that's going to be a significant increase for some people. Some special needs kids are also going to have some kind of taxes that need to be paid. There's going to be a reduction in the medical deduction. Right now it's 7.5%. Any medical expenses you have over and above 7.5%, you're able to deduct that. They are going to increase that limit. So that's the second wave. The next thing that we're going to look at coming with the Taxmageddon is the alternative minimum tax and the employer tax hike. Right now, not everybody is affected by the AMT, what we call the alternative minimum tax. The alternative minimum tax basically states that if you make over a certain amount of money, there is a minimum tax that you're going to pay. So if that means that there are certain itemized deductions that you will not have access to, like taxes, you're not going to be able to take that. The medical deduction, you're not going to be able to get that. So what happens right now is that they're going to decrease the income limit for the alternative minimum tax. And I'm hearing as much as if you make over $64,000 or $46,000, you will be hit with alternative minimum tax. Full business expense will disappear. This is important for business owners. Right now, if you spend money on equipment up to $100,000, you're able to get that as a write-off in the first year. For real estate investors, we've been doing cost segregation studies where, if you purchase a property for $100,000, we go in and we look at what part of that $100,000 can we reallocate or do a cost seg study on and allocate to personal property, things that are movable, the fridge, the stove, the carpet, the lighting, the dishwasher. And we've been able to fully expense that. Right now, that's going to be gone. We will now have to go back to depreciating it over 5 or 7 years. There's going to be a tax increase for benefit, tax raise on businesses, and the tax benefit for education and teaching is going to be reduced. Right now, teachers are able to get a $250 tax deduction. That's going to go away. Charitable contributions from IRA will not be allowed. So this is just a lot that we are expecting to happen come 2013. Now, right now there's a stalemate. We don't know exactly where things are going to go. I suspect that is the last week of 2012 is when the Congress is going to get their act together and let us know what they're planning to do. But either way, you just need to keep up with the news. Make sure you're signed up for our newsletters. Make sure you're talking with us to set up a consultation to see how this can impact you and how you can prepare right now for it. For real estate investors, I did, mention that I will tell you about the 3 major changes that are going to affect you as a real estate investor. This means your capital gains rate is going to increase. We started at a 15% long-term capital gains. We expect that that's going to go up to 23%. That is going to affect your deals. It's going to affect the way you analyze your deals. Right now you're analyzing your deals with about a 15% federal tax and, depending on what state you are, maybe about a 5 to 10% state tax. Right now, that's going to go up. So that means that you're going to have to offer a much lower amount as your MAO, your after repair value, is going to be much lower because of the taxes on what you have to offer. So this is going to affect the way that we do business as real estate investors. And the threshold amount, like I mentioned before, for the alternative minimum tax is going to be $45. So that means if you sell a property this year and the property that you sell this year, you generate about $30,000 of income and you have maybe another $30,000 of regular income, you are already over the threshold. You're going to be hit with alternative minimum taxes. There's going to be a 3.8% surtax that's going to be applied to your net investment income. That means right now, if you have investment income, you're just paying the taxes. There's going to be an additional 3.8. In other words, they're going to start charging Medicare tax on investment income. This is the first time that we've heard about that. Some of the solutions, I know some of it you may not be able to do. These are just things that we're throwing out there to help you get prepared. But like I said, you need to set up a consultation and so that we can discuss it and see how this affects you. We encourage you to, sell your property in 2012. If you are thinking of delaying, if you can put your property on the market, to see if you can sell it now and still take advantage of the 15% tax rate. Please do that. If you are considering for other reasons trying to defer it, you may not want to do that. See how you can qualify for material participation. This is for those that own rental properties. Material participation means that you spend more time in managing your real estate property than any other person, more than a management company or anybody else. So see if you can qualify for material or active participation. Better yet, are there things that you can set in place so that you become a real estate professional? A real estate professional means that you spend 750 hours in real estate in a year, and more time in real estate than in any other active profession. This is very, very important. I can tell you how many people that we've had to represent that have gotten out of that because they thought they were real estate professionals and they were not. If you have a regular job, you work 20-80 hours a year. That's 40 hours a week, 52 weeks a year, 20-80. you need to spend more than 2,080 hours in real estate if you have a regular W-2 job or you have a business. You need to show the IRS that you're spending more time in real estate than you are spending in your regular job if you're going to be considered a real estate professional. So that's very important. That's one of the solutions that you can to see if you qualify for the active or the material participation. Check your business structure. You know, are you a single member LLC, meaning that you're paying the highest amount of tax, or could you move to becoming an S corp? Could you consider, you know, moving into becoming a C, you know, can you set up a C corp before the year runs out? So there's several things that you can do. If you change your business structure, there's a lot more flexibility in terms of how you're going to be taxed. One of the things that I'm looking at for all my clients that are making over $150,000 and they are a small business owner, you're a real estate investor, or you have a small business, we're looking at setting up a C corp, or better yet, looking at setting up an LLC that will be taxed as a C corp and make that a partner in their multi-member LLC. That gives us the flexibility of allocating some income to that C corp and only have it pay a 15% taxes, because taxes on the first $50,000 of income for a C corp is only 15%. We never thought about doing that before. There was no need to ask a real estate investor to have a C corp. Now we have to do that because of everything that is coming on. Another thing that we say is plan for AMT and regular tax. You need to look at your itemized deductions. Is there a way that we can structure it? You know, for example, like the medical expenses. Can we have the medical expenses go through the C corp rather than it going through your individual return, knowing that it's going to be limited if it goes through your individual return? We definitely want to watch out for some red flags. Some red flags is, you know, expenses and exemptions are shrinking. You know, you don't have quite as many expenses and exemptions that you had before. Short sale or foreclosure, bankruptcy, those are things that we need to look at as well, where we might potentially lose deductions from the mortgage insurance premium. So these are all things that we need to look at. If you earn over $200,000, you will face a Medicare surtax on your W-2 income. So this is something that you want to be aware of. Again, we said that the capital gains tax rate are going to go up. Child tax credits are going to be cut in half. And the earned income tax credit benefits and education credits are going away. There are two things that you can do. Take action or just sit and watch and be like, I don't think this is going to happen, it's going to affect me. But you're much better off prepared. Even if it doesn't happen, you still have set yourself up long term to have more money available for you and your family. So if you have any income that you were expecting in 2013 that you can push into 2012, do that. If you have some deductions, you know, there's a lot of real estate investors who start out with education, and you want to take that education in 2012. Maybe you need to delay it and take that education expense for rehab, boot camp courses, take it in 2013. Consider, you know, if you have stocks that you need to sell, consider selling those stocks before the year runs out so you're able to take the capital gain in 2012. Get a self-directed pension plan. This is very important so that you're able to have control over what you invest in. Get a C Corp. I already talked about that. You want to plan ahead and then consult with me for the best action to take. 5 ways that you need to prepare for what is coming. You know, like I said, you must. It is absolutely very important that you consider year-end tax planning. It is very important that you think about it. And if you thought initially that you didn't need it, you're going to need it now. Defer income into the next year and save thousands of dollars. Shift income from a higher tax bracket into a lower tax bracket and do it before the year end. Do a profit extraction, taking money out of your business. Profit extraction, I'll give you an example. You're a rehabber. You go out, you find the property, you fund the property, like you do all the financing, you rehab the property, and then you sell the property. And you make $40,000. Right now, the way you have it is $40,000 is what you generated for all these services or all these activities that you engaged in for that one property. you can do a profit extraction by saying, okay, I made $40,000, but $10,000 should be allocated to me finding the property and selling the property. Another $10,000 should be allocated to me funding the property, meaning, working with the hard money lenders, coming up with your own funds and all that. And then $20,000 should be allocated to your rehabbing. If you bifurcate your income that way and move some of that income to the C Corp, you should expect to see significant tax savings by splitting your real estate income, or even, if you own a business, if you're a doctor and you also offer other services, consultant services beyond just, patient care, you can also bifurcate your income or do a profit extraction on your income so that it's not all tied to one entity structure. If you don't have a retirement plan, think of setting up a solo 401k plan. If you have your own business, you can contribute as much as $50,000, actually $49,500 into a solo 401k plan. So this is it. Like I said, we definitely had a lot to cover. I wanted to make sure that I covered it so that I can answer all your questions. I do see a lot of questions coming up again. Please feel free to give us a call at 1-888-502-3767, 1-888-502-3767, or you can reach us on the web at thewealthbuildingcpa.com, or feel free to send us an email at info@thewealthbuildingcpa.com. So right now I'm going to go to the questions. I'll try to answer as many questions as possible. And if I'm not able to answer your question on the line, we will try to get to those questions off the line. The first question is, can I schedule a consultation for tomorrow now? Unfortunately, the office is closed. We close at 6, but if you call first thing tomorrow morning and you ask for David or Marie and explain to them exactly what's going on, why you need a consultation, if you think you really need to come in, they will try to figure you in. What we do is, if my schedule is full for the day, they would wait list you, because sometimes, some people cancel their appointments or I have time in between. We can wait list you to talk tomorrow. The other question is, does having a legal business structure circumvent the need to show material participation? No. This material participation test has to be met regardless of the business structure that you have. It doesn't matter that the rental property is in your name or it's in the name of a single-member LLC or multi-member LLC and S Corp. You do need to still meet that material participation test regardless of what legal business structure you have. Okay, I have a lot of questions here, so just bear with me. All right, the next one is, any prediction what impact will make to invest using a self-directed IRA? In general, the reason why we suggest using a self-directed IRA is that you get to direct your own investments. That's what it's called, self-directed IRA. You're not working with a broker, who's telling you where to invest your money. You're investing your money yourself. Now, if you get good education, if you know about real estate investing, you know about investing in stocks, and you take responsibility for your own investments, most of the time you're able to get a higher rate of return directing your own investments than allowing somebody else to do it for you. If you were to invest in a mutual fund or you were to invest in a CD or bonds or whatever, you could expect maybe 5 to 7%, 12% return. But let's say you decided that you're going to become a private lender or a private JV partner in a real estate deal that is rehab, you could potentially see up to 15 to 18% return. That's much higher than what you would get if you just left those funds with a broker. And remember, part of what happened in 2008 was because these brokers were telling people that they should just put their money in the mutual fund and leave it alone. But you know what they were doing? They were actively trading in the mutual fund. So they were going in and out of funds. So they give you the impression that you put your money there and that's it. No, they are actively trading. And so if they're actively trading your own money, why don't you move into a self-directed IRA and direct your own investments instead of allowing somebody else to do it for you. Another question is, can the solo 401k be in a Roth, and can you receive a company match on that amount? The answer is yes, you can set up a solo Roth. However, there are a lot of restrictions on a solo Roth. One of the major restrictions on a solo Roth is that you cannot transfer an existing Roth IRA into a solo Roth IRA. It has to be new contributions that you make into a Roth IRA account. So that's a very good question. And you can also set up a solo traditional IRA, and you can contribute as much as $49,000. Of course, it's a calculation based on your income into that account, and you still have that money available for real estate. You can borrow up to 50% of that account for real estate, and you can use the money in the solo 401k to invest. The reason why I suggest a solo over and above a self-directed IRA, if a self-directed IRA, you're still dealing with a custodian who has to give you approvals and send the money and all that. With the solo 401k, like with our clients who have set up the solo 401k, it's just you and us. We act as a co-manager of the account. It doesn't give us access to the money. You are the only one that has access, but co-manager means we help you in making sure that you're properly investing the money where it should go. And so with a solo 401k, you have more flexibility because it is a business retirement account compared to the self-directed IRA where you have to go through a custodian. So just, that's just a little blurb that I wanted to put out there. Okay, somebody said, hi, Ebere, thanks for the webinar. To review my entity structure, how much will it cost? Well, we have different services that we offer, but to do an entity structuring planning, we charge $4.99 for entity structuring planning. If you wanted to do year-end tax planning, it's the same fee. With the entity structuring planning, what we do is we take a look at your entity structure, take a look at your strategy, and see whether that structure fits that strategy. If it doesn't, we'll go ahead and restructure it. Most times, our clients come in, don't have operating agreements. We go ahead and we set up operating agreements for you. We check to make sure that you're in compliance with the IRS as well as the state. I can't tell you how many clients that have come in thinking that they had an entity, only for us to go to the State Department of Assessment and Taxation and realize that their entity had been forfeited. And it's been forfeited because they were not being compliant every year, paying the annual fees and filing whatever tax returns need to be filed. And each state has their own requirements. If you're in New York, you need to file those by February 15th and pay the $25 fee. If you're in Maryland, it's $300. If you're in California, it's $800. Each state has their own filing requirement. So yes, we offer entity structuring consultation for $499. All right, let me see here. Can I deduct property improvement expenses on my rental property this year, even if I don't sell it until next year or later? The answer is yes, because it's a rental property. If it's going to be a rental property and you do improvements, you can take it. Now, you may not be able to deduct it all because if it's an improvement, you will need to depreciate the improvement. The other thing that you need to do is to know the difference between what is an improvement and what is a repair. If it's a repair that you did, repair means, you want to keep it in the current working condition. Absolutely, you can expense it now, but if it's something that substantially improves the value of the property, then it's an improvement. You would have to depreciate it. So while you may be able to take it in the current year, you may not be able to take the whole amount. You may have to end up depreciating some of it. All right, let's keep going here. Do I have to file taxes if I have an LLC that I haven't used yet at all? If it is a multi-member LLC, the answer is yes. You want to check the EIN letter that you received when you requested an EIN from the IRS. It will tell you on there whether you have a tax filing requirement. And I'm glad you brought this up because a lot of people make mistakes thinking that, oh, I didn't have any activity, so I don't have to file. If you're a C Corp, an S Corp, or multi-member LLC, you are required to file a tax return, even if it's a zero return. If you have a single member LLC, then you necessarily don't need to file. Now, this is the filing that you do with the IRS and with the state. You're still required, even if you're a single member LLC, to pay the personal property taxes. So you have to file your personal property taxes if you're in the state of Maryland. That you still have to do, but you don't need to file a return for a single member LLC if you didn't have any activity. All other entity structures, you would need to still do that. Okay, let's keep going. Somebody is asking, how much do we charge to prepare taxes? It depends. Every tax return is unique. We charge based on the number of forms that we have to file. So if you shoot me an email or send me a copy of your return, the 2011 tax return, we can get you a quote. The other way of working with us, if you decide to become a member of the Wealth Building Program, you just pay the one fee for the Wealth Building Program, and it covers your tax preparation, your entity structure, and the year-end tax planning, the business meetings, and the limited consultations. All right, I have another question here. If I earn almost all of my income from rental properties and interest payments for lending to rehabbers, do I even need to structure as a business at all, since these are passive investments? Not necessarily. However, and I'm glad you brought this up, I have clients who only earn rental income, but they need to show business income. Let's say they're trying to qualify for a loan, or they want to put money away for retirement. So if you wanted to put money away for retirement, we would now need to pay you a management fee from that rental income or from the interest payments. Even though you're going to pay self-employment tax, it enables you to make a contribution to a retirement plan. So you necessarily do not need a restructure if all you're getting is interest and rental income, but sometimes you need to consider restructuring if you wanted to be able to make a contribution to a retirement plan, or for other reasons, like if you wanted to get a loan, lenders will not lend based on passive income. They look at active income to be able to convert some of your passive income into active income. I'm glad you brought that up because that's a very important question. All right, let's look here. Okay, on multiple properties, must you show material participation on all or only a particular percentage? Counting multiple properties as one possible takes care of this. Yes, by doing what we call, an aggregate election. You would need to file an aggregate election, which what you're basically saying is that you're making an election to treat all of your rental properties as one. And that way the material participation test can be met on just one level rather than having to establish it for all the rentals. All right, somebody wants me to speak to the pros and cons of having multiple rental properties looked at expense-wise as one by the IRS instead of an individual. I think I just spoke about that. One of the pros of doing that is definitely that you don't need to meet the participation test for each property. You're able to just aggregate it and it's looked at as one. In terms of expense-wise, it doesn't necessarily mean that you just report one rental income and one rental. You still report the property separately, but when it comes to the material participation test, it's still aggregated. So it doesn't necessarily mean that everything is bunched up into one object. So you still report the property separately, but then when it comes time to the test, it's all aggregated. So I hope, that's the question that you're asking. Okay, let's see here. Okay, what has to happen for all or none of these tax changes to take place? Really, I don't know. Fire everybody in Congress and get somebody else? I really don't know. One thing I can definitely tell you that is very important, some type of tax change is going to occur. If you think about it, how much money that we have, trillions of dollars in deficits, our national debt, we have two options: to find ways of reducing that debt or to keep going and then end up getting into a major disaster as a country. both parties, both Republicans and Democrats, agree that we do need to cut the budget. So that one, there's an agreement that the budget needs to be cut. It's just a matter of how do we cut it. So the congressmen that are Democrats are saying cut it this way, and the congressmen that are Republicans are saying cut it that way. And that's why sequestration came in, because they said, look, if we're not able to come to agreement on how it's going to be cut, these cuts are going to move in automatically come January. So some type of tax cut is going to happen. Some type of budget cut is going to happen. Some type of tax increase is going to happen. It's just a matter of who is going to be affected by it. All right, what is the one wealth building plan fee? Right now, our wealth building plan is at $19.95. And if you send us an email at info@thewealthbuildingcpa.com, we can send you some material on what it covers. It's also available on our website. So you pay $19.95. However, if you're a member of AREA or you come as a referral from another client, you get a $300 discount. So you can get it for $16.95. We have another program, the Wealth Building Plan Program B, that is at $12.95. You're able to get that by, you get to pick and choose what services that you want, an aggregator of services. So Wealth Building Plan A covers everything, including entity structuring. Wealth Building Plan B does not cover entity structure. It covers everything else, the tax preparation, year-end tax planning, business meetings, retirement planning, investment property analysis, and limited consultations. So that's what's covered in the plan. It's very comprehensive. We get to work with you the whole year. Most of you are used to working with your accountants where you're only talking to them once a year. We talk to our clients at least 4 to 5 times a year. That's when we reach out, not included the times that they reach out to us. The first time that we reach out is to prepare the taxes and plan for taxes. The next time is we do business meetings. The next time we do is entity structuring. The next time is retirement planning. The next time is year-end tax planning. So we reach out to clients during this time and ask them, if there's anything we need to do, or, they need to call us so we can take a look. And on their own, they also reach out to us. If they purchase a property, they can call us. If they sell a property, they call us. If they've made more money in a business, if they're going through a divorce or had a child or a death in the family, if something happens, they can reach out to us and we plan. So we work with you throughout the year as a member of the Wealth Building Program. You also get access to our newsletters, and you get priority when it comes to scheduling appointments. All right. Let me go back here and make sure that I've answered all the questions. Please keep the questions coming. This is very good. Property improvement, I answered that already. Just give me a second as I try to get through some of these questions to see if there's any. Okay. So it looks like we were able to get through all of the questions. And if there's any additional questions, please feel free to go ahead and send it. We are starting to wind down here. Again, like I said, this is a lot of information. It's not designed to scare anybody. It's just designed to help you prepare. Also, one of the things that I wanted to talk about as I end is ultimately, what should you be doing? Ultimately, my personal philosophy is that you should have multiple streams of income. You should not just depend on just income from your regular job. You shouldn't just depend on income from real estate if you're a full-time real estate investor. You shouldn't just depend on investing in the stock market. Make sure you have multiple streams of income in different industries so that if at any point in time one industry is being affected, the other industry is intact. I cannot overemphasize how important it is. We've heard, from Robert Allen about multiple streams of income. Income that you generate from stocks, income from real estate, income from having your own business, and then having a regular job or what you call, or an internet business. So if you don't have multiple streams of income, you're only getting a paycheck, you're only getting income from rehabbing a property, you're only dependent on interest payments and rental income, you definitely need to add on other income. It's going to involve some training and learning and education in order to get there. But look at it this way. Would you rather be learning when you don't have the money, or would you rather learn now and know that you've set yourself up for the future? So it's very important that we as investors, small business owners, as responsible wealth builders, that we have different sources of income. For me, I'm a CPA. I love what I do as a CPA. This is, I've knew since I was 5 years old I was going to be a CPA. I also love real estate. And my primary strategy is buy and hold. But this year, I went into rehab, and I am rehabbing properties with a couple of my clients. We came together and said, hey, we love real estate, but we also love what we do full-time, but we want to be able to invest in real estate. And so we partner with another investor who does real estate full-time, and we're working with him to rehab our first property. We started this whole venture in August. We raised money. We purchased a property in Landover, and we're getting ready to have that property on the market, and we're hoping that property, we're going to be doing the staging this Sunday, that we can sell that property before the year runs out. How many hours does it really take for me to do that? But if I'm able to have rehab income coming in, rental income coming in, business income coming in, if something happens in the market, at least one of these should still be intact. So I encourage you, of course it requires a lot of learning sacrifice on my part, having to go to the property on Sunday and listen to the rehabber, talk about all the stages of rehabbing. I had to be the one to raise the funds. I had to educate my clients on what it takes for us to have a partnership, to do a JV. All of that is extra. This is an addition to what I already do. But I am setting up an extra stream of income. So it's very important that as a wealth builder that you find other ways of generating income. All right, so as we wrap up now, I wanted to thank everybody. Thank you so much for being on the call. I hope you have a wonderful Christmas and a wonderful New Year. Please feel free to call us at 1-888-502-3767. Or you can go to our website. We have a lot of material. If you're not getting our newsletters, please sign up to receive our newsletters at thewealthbuildingcpa.com. If you have any additional questions, please feel free to call me at info@thewealthbuildingcpa.com. Have a great evening.